Welcome to the Explainer. Today we're digging into Qualcomm, or Qcom, and folks, it's a real tug of war. You've got this powerful uptrend on one side, but on the other, well, there are some pretty serious signs that it's getting tired. Let's break it down.
So here's the plan. We'll start with the trend itself, then we'll look at the case for the bulls and the bears. After that, we'll pinpoint the key price levels where this whole thing could be decided and wrap it up with 3 possible ways this could all play out.
All right, let's jump right in. Looking at the big picture for Qualcomm, you can't miss it. The stock is clearly trending up. But, with any big run like this, the million-dollar question is always, does it have the legs to keep going? Is there enough gas left in the tank?
And here's our starting line, 179.43. This is the price right now. Everything we're about to talk about, every indicator, every theory, it all comes back to this one number and figuring out where it's headed from here.
Okay, so this slide really shows you the balance of power in our tug of war. These numbers basically measure the strength of the buyers versus the sellers. And wow, look at that. The upward force is way up there at 43.30, while the downward force is just 8.94. I mean, it's not even close right now. This is the engine that's been pushing the stock higher.
So, with that in mind, let's grab the rope on the bullish side of this tug of war. What's all the evidence telling us that this climb can keep on going?
And yeah, the case for the bulls is pretty solid. First off, the price is sitting above all its key historical averages. We'll talk more about what that means in just a sec. But beyond that, you've got a whole bunch of momentum indicators just flashing green. Like the Arun up indicator is at 92 out of 100. That's screaming strong trend. Then you've got another one, the MACD, basically giving a thumbs up that buyers are still in the driver's seat. It all paints a picture of a really consistent positive trend.
Okay. So I mentioned moving averages. What the heck are those? It's actually pretty simple. Just think of them as the stock's long-term memory. Its average price over the last 50 days, 100 days, and 200 days. When the current price is above all of those averages, like it is for Qcom, it's basically saying the stock is outperforming its own history. For a technical analyst, that's a classic, textbook sign of a healthy uptrend.
But it's not all sunshine and roses. This is a tug of war, remember. So let's drop the rope on the bulls side and go pick it up for the bears, because there are some pretty big warning signs flashing that suggest this whole rally might be running out of gas. And this right here, this is a big one. It's a classic red flag that traders are always on the lookout for. See how the price is climbing up, but the trading volume, the number of shares being traded, is actually going down? That's what's called a divergence. It's like a party where the music is getting louder, but people are starting to leave. It suggests the conviction, the belief in this rally is starting to dry up.
And to put a hard number on that, the volume lately has only been about 78% of what's normal for this stock. You really want to see strong volume supporting a price move, it shows commitment. When that volume fades, like we're seeing here, it's definitely a reason to be a little cautious.
And the list of red flags keeps going. We have several indicators basically shouting that the stock is overbought. It's like a sprinter who's been going flat out for too long and is about to hit a wall. The price is also hitting the top of its Bollinger Band, which is kind of like a statistical rubber band. When it gets stretched this far, it often wants to snap back. Add to that a weakening money flow, and you get a real feeling that this rally is just getting worn out.
Okay, so we've got the bulls pulling one way, the bears pulling the other. Where does the battle actually happen? Well, in the world of stock charts, the fight always happens on a clearly defined battlefield made up of a few key price levels.
And here they are. You've got resistance up at 182.40. That's the ceiling the bulls need to break through. Down below, you have support at 177.54. That's the floor the bears want to smash. But the real line in the sand, the no man's land of this battle, is that pivot point at 180.52. And get this, the current price is just under it. The stage is set for a major showdown right at that level.
So, how does this all end? With all this conflicting data, this tug of war, the analysis really boils down to 3 possible ways this could play out from here.
Scenario 1, the bullish path. The stock punches right through that 180.52 pivot point. That could be the fuel it needs to make a run for the resistance ceiling. Scenario 2, the bearish path. It tries to break the pivot and fails. That rejection could send it tumbling back down to its support floor. And then there's Scenario 3, the neutral path. The bulls and bears just fight each other to a standstill right around that pivot, and the stock just goes sideways for a bit while the market figures out who's really in charge.
So let's bring it all together. What's the big takeaway from this whole tug of war? It's this: the bulls are still winning,
Technically, the rope is on their side of the line, but man, they are looking tired. The weakening momentum and that fading volume, it's like they're trying to pull the rope while running through mud. So yeah, the trend is still bullish, but you just can't ignore these signs of exhaustion.
And that leaves us with the million-dollar question, doesn't it? Is this just a healthy pause, the stock catching its breath before the next big push higher? Or are these warning signs telling us that this incredible rally is finally truly running out of steam? That's the puzzle.